Let's start with the first loser coming out of earnings, and that would be none other than Inogen, ticker symbol INGN. Brian, you and I did a show earlier this month about the very lucrative respiratory disease market. This was the company that was founded by college students, really on a mission inspired by one of their grandmothers who had to carry around a heavy oxygen tank. A story I could get around. We saw a lot of the founders still involved with the business. In that show, we did talk about their business model, how they make money, but we also talked about some of the headwinds they had been experiencing up until that point. It sounds like second quarter, still headwinds are ongoing. Before we dive into that, though, Brian, let's just do a quick refresher of what it is that they focus on.
Yeah, so Inogen was the innovator of portable oxygen concentrators. So as we spoke about on our last show, there are a number of patients out there that need supplemental oxygen therapy to help them get the oxygen they need because they have reduced lung capacity for a variety of reasons. The number one cause is typically a long life of smoking, where your lungs just can no longer absorb the amount of oxygen that they need. So a portable oxygen concentrator is a very miniaturized device that actually continuously creates oxygen, concentrated oxygen from the surrounding air. It's it's very quiet. It's much more convenient for patients to carry this around than having to lug oxygen tanks behind them. So these guys were taking heavy market share in the oxygen therapy market for years. This company came public a few years ago. It was a red hot stock. I mean, this company was just humming along, growing at a double-digit rate, profitable, cash flow positive, clean balance sheet. Everything was going splendidly. And then the wheels started to fall off the bus about 6 months ago. Their revenue growth significantly slowed due to reimbursement headwinds and some employee challenges with sales execution. We noted that in our last show that perhaps the stock may have been of value when we brought it up a month ago. Well, the stock price is now significantly cheaper than it was even a few weeks ago based off of their Q2 results. So Q2 results were just not good at all. Revenue growth slowed all the way to just 4% revenue growth. That was well shy of what Wall Street was looking for. Gross margin fell, expenses jumped, and that combination just caused net income to crater 30%. So it dropped significantly versus the year ago period. And I think the thing that capped it off with Wall Street was that they cut their guidance for the year. Previously, they were expecting 405 to 415 million in revenue. They dropped that number all the way down to 370 to 375. Wall Street was not happy.
Not happy, to say the least. And I mean, last quarter, management, as you mentioned, was talking about some reimbursement headwinds, also talking about productivity with some of their new hires on the sales side. But also we talked a little bit about them shifting their revenue, their business model to more of that rental model to try to see some of that recurring income. And obviously, anytime you're shifting revenue mix, there's going to be some short-term pain, which hopefully should play out over the long term, we hope. But all in all, it still sounds like there's a lot of blame being put on the sales staff. And it sounds like they even had to cut some from the sales staff.
Yeah, I mean, that's exactly what the CEO, Scott Wilkinson, said. He basically said the level of sales representation attrition was higher than we expected. And many of our new hires were unable to meet their sales targets. That to me sounds like there's a hiring issue and potentially a internal cultural issue that is repelling salespeople. There could be something underlying going on that is preventing these new sales hires from meeting their targets. So this is definitely. In my opinion, this could be the sign of something not going right at the company as opposed to just a one-time blip.
Yeah, and I guess to the surprise of many, they also announced an acquisition, a company called New Era, that's spelled AERA, that makes portable non-invasive ventilators. This was a $70 million in-cash deal, up to $31 million in potential earnouts. What are your thoughts about this acquisition? Does that change kind of where the company is at within the short term? What do you think about that?
A quick look at the acquisition, I think it makes sense. So the company that they acquired, like we said, $71 million plus another $30 million in earnouts if certain targets are met. So they make non-invasive ventilators that are designed for patients with chronic lung disease that need higher levels of oxygen. So they produce products that create higher flow rates, higher pressure, and it looks like an acquisition that really makes sense for this business. They said it's going to be accretive to sales starting next year. Gross margin could increase from it. It will leverage all of their existing infrastructure. So on the surface, this looks like a smart deal. The thing that I worry about is this their way of buying growth? Because their core business is not executing, and potentially could this be a unwanted distraction for the business when they should be paying attention to re-executing and getting their core business on target? So high level, I think the deal makes sense. I'm not sure if right now is the perfect time for them to make the acquisition.
Yeah, great points there. Management did say they're hoping to return to double-digit top-line growth here in 2020. This sounds like a story we're just going to have to really wait and see. Not entirely confident, but let's keep the show going because we've got another loser. This one kind of hurts my heart, Brian, because this is a company that has just been beaten down really over the past year and a half, and that is none other than Abiomed. That's ticker symbol ABMD, a leader in what's known as the heart recovery field. The hits just keep on coming, Brian. I mean, when you look at the stock price just over the last year and a half, stock is down right now about 56% from its high. You and I talked about this company in May most recently. Before we get into their fiscal first quarter of 2020, let's just give a quick refresher. What is it that Abiomed actually does and what's their tech?
Sure. So Abiomed makes minimally invasive temporary heart pumps. That are put into a patient's heart either after they've had a heart attack to help alleviate some of to keep the blood flowing and alleviate the pressure that's placed on the heart so it can recover. Or it's also used before a heart surgery is performed on a very high-risk patient, and it basically makes a high-risk surgery a lot safer. It lowers the risk profile. And these guys have the data to show that when you use this device, it leads to much safer outcomes, faster recovery, so they're out of the hospital faster. And Abiomed is really the only company that does what they do with minimally invasive heart pumps. So these guys they've just been crushing it for years, and Wall Street really bid up this stock to very, very high levels. I mean, price to sales ratio was above 20 just about a year, 18 months ago. But they definitely deserved it. They were just putting up unbelievably consistent growth. Margins were expanding. They're profitable. They have tons of cash, no debt. They were just a rock star company. But as we touched about on the last time we talked about them, in February of this year, the FDA issued a warning letter to healthcare providers that made it seem like one of their heart pumps was not safe to use and it was being recalled. That was not the intent of the letter, but the media picked it up and it just spread like wildfire. And Abiomed has basically been in damage control mode since February. So that letter came out and they actually missed their first quarter earnings targets for the first time in basically years. And they said that they were going to refocus their efforts, redouble down on education to make sure that the medical community was aware of what was happening. In fact, in May, so just a couple of months ago, the FDA issued another letter basically saying that the product in question was safe to use and was effective. So Abiomed has been going around with that letter and letting the medical community know that yes, indeed, everything is as we said it would. But since that letter didn't come out till May, Abiomed hasn't had enough time to reverse the damage. And we saw that reflected in their Q2 sales results. So revenue grew 15%. to $207 million in the quarter, which sounds really good, but that was short of the $211 million that Wall Street was expecting. The sales miss had the gross margin decline a little bit. Earnings did okay. GAAP earnings fell 1%, but adjusted earnings were actually up much more. This company has some one-time adjustments in its numbers based on some equity investments that it's made. But the big shocker here was that they lowered their full year guidance. So they were previously guiding for 900 to 945 million in full year revenue. They pulled that back to 885 to 925, which represents growth of about 15% to 20%. But Wall Street was just not happy with the guidance reduction once again. On the day of this report, their stock was just crushed, 28%, down 28% in one day on the news.
So with the stock down like that, Brian, it looks like right now it's trading for about 11 times sales. So certainly off of its highs. Do you think perhaps this right now, Abiomed is past the worst of it? It's really just going to take time for the re-education to regain the trust of maybe the physicians and patients. Do you feel like we've kind of already hit a bottom, if you will?
In my personal opinion, I think the answer is yes. I view this as a wound that was basically Abiomed had nothing to do with, and they've been in recovery mode ever since. But if you zoom out to the bigger picture, the opportunity here is still massive. Abiomed's market share in their treated fields are still single digit, even in the U.S. They're expanding internationally, particularly in Germany and Japan. And in fact, in response to they knew that Wall Street wasn't going to react well to this, so they immediately announced a $200 million stock buyback authorization. They also won FDA approval for a new Impella device during the quarter, and their balance sheet just remains flawless: $527 million in cash and no debt. So they will have no problems affording every program that they have going on and being able to buy back stock. So I personally view this as a blip in the road as opposed to something that damages the long-term story.